Let's discuss the key components of IFRS 15. 1. 5-step model. The 5-step model outlines the process for recognizing revenue and financial statements. This includes the identification of the contract, identification of performance obligations, determination of the transaction price, allocation of the transaction price to performance obligations, and recognition of revenue. The importance of following this model is that it ensures proper recognition of revenue and financial statements. The key persona involved in this process would be the finance team, and the related IT customization details would include the implementation of an accounting software that supports the 5-step model. 2. Performance obligations. Performance obligations are promises made to customers in a contract to transfer goods or services. IFRS 15 requires that revenue be recognized only when a performance obligation has been satisfied, which typically occurs when the good or service has been transferred to the customer. The importance of understanding performance obligations is that it ensures that revenue is recognized only when the customer has received the promised product or service. The key persona involved in this process would be the sales team, and the related IT customization details would include the implementation of a CRM that tracks performance obligations. 3. Transaction price. The transaction price is the amount of consideration that an entity expects to receive in exchange for transferring goods or services to a customer. The transaction price must be estimated at the contract inception and revised if necessary. The importance of understanding the transaction price is that it ensures that revenue is recognized at the correct amount. The key persona involved in this process would be the finance team, and the related IT customization details would include the implementation of a pricing tool that accurately estimates transaction prices. 4. Allocation of transaction price. The transaction price must be allocated to each performance obligation in proportion to the standalone selling price of the good or service. The importance of proper allocation of transaction price is to ensure that revenue is recognized accurately. The key persona involved in this process would be the finance team, and the related IT customization details would include the implementation of an accounting software that supports allocation of transaction price. 5. Contract costs. IFRS 15 requires that contract costs be capitalized and amortized over the period in which the entity expects to fulfill its performance obligations. The importance of capitalizing and amortizing contract costs is that it ensures that costs associated with fulfilling the contract are recognized over the same period as the associated revenue. The key persona involved in this process would be the finance team, and the related IT customization details would include the implementation of an accounting software that supports capitalization and amortization of contract costs. 6. Disclosures. IFRS 15 requires extensive disclosures to provide users of financial statements with an understanding of an entity's revenue recognition policies and practices. The importance of these disclosures is to ensure transparency in financial reporting. The key persona involved in this process would be the finance team, and the related IT customization details would include the implementation of a reporting tool that facilitates the creation of such disclosures. These key components of IFRS 15 provide a framework for revenue recognition that is based on the transfer of control of goods or services to a customer, and that provides users of financial statements with information that is relevant, reliable, and comparable. We really thank you for your time spent on this session. Feel free to meet our partners by sending an inquiry email to contact us at t24global.com. Most of our partners have 15 to 20 years industry experience. So, please get in touch for any quick, managed business process and IT consulting needs.